Hey everybody, happy Friday to you. Do you know it's the last Friday of August? Okay? Last trading day of August, actually. So we'll take a look at that in just a sec. But welcome to Advanced Options. Good to see some familiar names out in the chat. And if you're watching on a recording, hey, glad you're here too. We do this each week at this time. This week we're going to focus on butterfly spreads. We talk about different topics, different weeks. Last week we talked about double calendars. Connie helped me out with that one. And the week before was, I think, Iron Condor. So just go back in the archives if you want to see different types of strategies discussed. We'll do that. But today, butterflies. I'm joined in the chat by Scott Thompson, helping me out. Always appreciate Scott. And uh, I've been working with Scott for a lot of years. He's very knowledgeable in the areas I'm going to be covering today. So as you have questions, feel free to type those in the chat between Scott and myself. We'll do our best to get you helped out there. You can follow us on Twitter or X as well, at Brentmore CS, at Scott Thompson CS for additional content throughout the week. Remember, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only, and it is not an individual recommendation or endorsement of any particular security, strategy, chart pattern. You get the picture. So these are going to be examples today. We'll look at individual stocks and trades, but that's all they are, examples. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money application is provided for educational purposes only. We may not factor in commissions or fees in these examples that we do, but just realize they are a real thing you need to factor in. All investing involves risk, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the money amount. And there's no guarantee of an execution of a stop order that it's going to be at or near the stop price. Okay, so there we go. Hey, we cover a lot of different strategies in this class. This is just a little slide that I have. A lot of these strategies that we cover are a little bit more in the neutral area. When you see this delta plus minus, it can be plus, it can be minus, it can be kind of almost nothing, but it changes if the stock changes. Delta tells you how bullish or bearish we are. Butterflies are normally, we kind of consider them more of a neutral trade, but you can, depending on how you do them, you can make them more bullish or bearish, and we're going to look at that today as well. Butterflies come in different varieties. It's like in nature, butterflies are beautiful. In options trading, butterflies can be beautiful. But just because of the variety of what we can do. I'm going to try and show you some of the variety that you can do with butterflies today. One thing about butterflies is they are positive time decay. Theta is positive on those. That's a nice thing on those. They are negative vega trades, but they're not super strongly. I mean, we may skew it more bullish or bearish, but if you want something that's super bullish or super bearish, it may not be the trade for you. Maybe you're looking at a long call or long put or something like that. So there we go. So let me go and hit up the Thinkorswim platform. I mentioned today's the last trading day of August. Can you believe how fast the year is going? We're at the end of August. How'd the month wrap up for August? Communications. These are the sectors. This is the monthly performance. Up almost 6% for the month. That was your leader for the month. Materials up a couple percent. Financials doing fairly well. Real estate not so good. Industrials, utilities not so hot. It's but this is the overall market. Okay, this is the overall market, skewed a little bit more towards some of the bigger sectors such as IT and communication services, and hence what we have is we have a nice upward slope in the overall market there in terms of the trend of the overall market. So let's move on and let's take a look at what I want to do is I just want to give you some examples of butterfly spreads and then talk about how to trade them, how to manage them, some of the attributes of them. I'm going to take something that's kind of maybe a little bit more in the neutral realm. Okay. On this graph, by the way, and I'm going to do this today. I'm going to just to kind of introduce for those of you who aren't familiar with it. I'm going to have this volume profile over here on the graph. What's the volume profile? It just shows how much volume has occurred at each of the prices that this stock has hit over, in this case, 6 months. So most of the volume, you can see that right here, has been in this area. And the theory is, if there's been more trading there, it's more likely to stay kind of in that area. So given that, you may see why maybe we kind of could possibly have more of a neutral forecast on that. That's no guarantee. You know, this could be the start of a big uptrend or downtrend, but right now I would say we don't really have that much of a definitive trend here either way. And our volume profiles kind of say, well, maybe we'll stay kind of in this area. That's the technical basis for Kraft Heinz here, KHC. Okay, so that's what we're going to start off with, this kind of more of a neutral type trade. How long am I going to go out for? Typically on butterfly spreads, we're looking, and this is just going to be a ballpark figure that I'm using. You don't have to be exact on this, 20 to 50 days. Okay, remember they're positive theta. Time decay is helping you out. You want to get in your trade. You want to be in trades when the time decay is more impactful. Could you do a butterfly that's a year out? You could. Theta is going to be much lower in that situation as well, though. And then you're trying to predict out for a very long period of time where the stock's going to be. Not as typical there. So that's how we're going to start out. So if I'm doing a butterfly spread, I'm coming up with my forecast, and I want to say, look, in this case, I'm going to find something kind of where this is what we call the point of control on this volume profile, this red line. This is the area with the most volume, right around 27 and a half. So that's where I'm going to center my butterfly. What's a butterfly? You can do them calls or puts, but you're going to do a long contract. You're going to sell 2 short contracts, and then you're going to do another long contract at a lower strike. That's how a butterfly is constructed. Okay, you can do all calls or you can do all puts on that. Typically, if the stock is, if your strike is above where the current price is, then we may look to do more. Let me restate this. If this is your center strike, if the stock is above here and you expect the stock maybe to go down to it a little bit, okay, then what you may do is you may do like a put in that case. Or if the stock's a little bit below where the center strike is, we may do a call in that strike price. In other words, we kind of do them out of the money typically. Why does it do that? Well, one, it lowers your chances of early assignment because remember, short options can always be assigned early. Okay, fair enough. So let's just look at an example here. Okay, we're going to look at an example. Kraft Heinz, we're going to look at 27 and a half. The stock's around, it's a little bit higher than that right now. It's almost closer to 28 right now. I'm going to go to the monthly contracts, 21 days, which fits our parameters here. I'm going to go to puts. I'm going to go to 27 and a half, and you can look at these individually, or you can go up to here where it says spread. You can go to butterfly. Pretty easy, right? You just switch the spread right there to butterfly, and it's going to do this. Now, you can always tweak the strikes once you have them. I have 27 and a half, 27, 28. I'm going to click on the ask price. These are debit spreads, okay? These are debit spreads. And here we go. So Paul's saying, why not Iron Condor? Well, number one, Paul, we're talking about butterflies today. That's one reason why. But I'm going to tell you why. There's pros and cons, and I'm going to get into the pros and cons of those, okay, as to why. And we're going to see that in just a sec as I'm going to do an analyze. I'm going to analyze this trade here. So let me right click on this. I'm going to analyze the trade, and we're going to go to risk profile. What's some of the differences between iron condors, which is another another possibility, versus for a neutralish trade, and a butterfly. Paul asked a great question, and I appreciate that. When would you do one versus the other? Because there's a lot of similarities between them. Remember this when we were looking at this? When we looked at this, here's your butterfly, here's your iron condor. Look at the delta. It looks pretty much the same, okay? Look at your theta. It's pretty much the same. Look at your vega. It's pretty much the same. So for Paul's question of why are we doing, and these are going to be pretty, not that dissimilar there. So what is the difference between these? So it was a perfect question. Well, here's one of the differences. Typically, when we're talking about butterfly spreads, they're a lower probability trade with a higher potential reward, okay? Whereas iron condors, not so much. Iron condors, the way we typically construct them, are going to be a higher probability trade with a lower reward. You can just look at your risk profile here on this, and if you look at the difference between, here's break even right there, okay? Here's your break even. Look at the difference between the break even and your max loss and your break even and your max gain. Well, look, more potential gain on that butterfly. What's the downside? There's no free lunches, folks. You don't get that nice profile without a big downside, and the big downside is your probability isn't going to be very good. Now, we can tweak those strikes, and we're going to tweak those strikes in just one sec, but this is pretty versatile in this regard here, okay? So let's start with this, and just let's kind of look at probabilities here, or let's look at probabilities. So I'm going to go to September 20th. I'm going to click on my set slices break even, okay? And here we go. Look at the way it gets constructed. It's only showing me a 15% chance, or close to 15% chance, of being break even or better. Now, that's great if the stock stays right in that really narrow area, but that's probably too tight for a lot of you out there. But most of you aren't willing to go with odds like that. So what can we do? We can say, well, that's kind of tight here. Look at our strikes. When we automatically did it, they put them in at a half a dollar apart for each of those. So I'm going to go up, and I'm just going to expand that out a little bit. Let's look at what happens when we expand it out. Oh, do you see what happened when I just changed those strikes out? I widen this out. Now, when I'm looking at my break-even points, instead of, what was that, 18%, I think it was, when I widen it out, now we're at about 33.5%. That's a little better. Notice, hold on one sec. Let me do this. Okay, actually, I didn't unlock that, so it was off a little bit. Now it's about 29% or so, okay? Let's go and let's continue the process. Let's go a little bit wider. I'm going to go to 29 here and 26. So instead of a half point apart, they're a point and a half on each of these. Let's go here and see if we can get a little bit better. Let's go to our break evens, which are right about there, right about roughly there. Now we're at about 33, almost 34%. Okay. So now the farther we pull those out, okay, the less the difference between our max gain and our max loss was. Remember when the first variation we looked at, how the max gain was so much more than the max loss? It's still a little bit more, but it's getting, our probabilities are going up, but our reward to risk is getting a little bit worse on that. So going back to the iron condor butterfly thing, the butterfly is generally a lower probability trade with more potential gain if you kind of hit it right, if things go well for you. Okay, that's when we're going to do this. Now, we're going to go through some variations today on these and talk about that. But let's just kind of stick to this one. I want to just do kind of plain vanilla butterfly spread. When someone says butterfly spread, this is what they're talking about here on this. Neutral trade. And remember, I kind of said maybe 20 to 50 days out in terms of what we're targeting on our expiration. Play around with your strike prices. Get them wide enough, but you can just play around with them. You can kind of get diminishing returns the farther out you pull them. But there we go. So that's what that looks like. Now, when are we going to get out of this? First of all, it's a slower moving trade. It's dependent on the time decay. So we're going to be patient with it. Under 10 days, when we get to be about a week till expiration, we're going to exit this. In this class, that's how we're going to take care of that. Otherwise, you can, if you want, just kind of let it run. Now, you can put exits on there if you like. And where would we put our exits? Well, one approach is to do this, is to say, hey, look, if this goes outside our bounds, it's going to wiggle around a little bit probably, but if it goes way out there, maybe about above 29, I'm going to get out, or below, down here, below 26, you can put in exits based on the stock price, but you got to give it some wiggle room. And one thing to always remember is even if it goes against you, let's say it goes outside of our break-even points here, and it goes to 28.5, and we're looking at this losing position. Remember, if you're not, even if it goes to, let's say it goes all the way to 29.5, which is quite a ways out there. Notice, at expiration, that's our max loss, and it's limited, but before expiration, that's more represented by this purple line. And so you're unlikely to be near a max loss as long as you're not near expiration. Okay, there's it's a moving target, so I can't say that definitively. It is possible to be near max loss before expiration, but just realize there's a difference between when we look at this graph and talk about at expiration and before expiration. All right, so we can do that. Other common kind of exit rules that people will use, they may decide to get out if they've made 80% on this trade, okay? If they've made 80%. So you can see kind of you can see what the max profit is. The reality is we're probably not going to hit that max profit because the stock's probably not going to be right at that middle point, right? The odds of that are pretty slim. So getting out at 80% may make sense. However, if we use that exit that I said, which was about a week, okay, roughly a week till expiration, if you look at it there, that may be the time to get out. You're probably not going to reach an 80% gain before that point anyway, to be very honest. But so here's the trade, and let me just go back there. Go back here and do this. So let me go to trade, and let's right click on this. Let me just confirm and send real quick here. So max, hold on, let me edit this. Let me go. I'm going to put in my exit here on this. I'm going to create an opposite order on this. So I'm going to do a first triggers sequential order. I'm going to right click on this. I'm going to create an opposite order, and I'm going to go, and we said we're going to get out if the stock goes above 29 or below 26. I'm going to make it good till canceled. I'm going to make it market. I'm going to click on the gear. I did that wrong. Hold on one sec. I never changed the strike prices here. That's why this was it didn't look right to me. We changed this to $1.50 difference on these. $1.50 difference. So this is going to be a 26. This is going to be a 29. This is going to be a 26. Let me just click here. Okay, there's our entry order. Here's our exit order. Good till canceled, mark it. Click on the gear. We're going to get out if Kraft Heinz marks less than or equal to, what do we say, 26. Kraft Heinz marks greater than or equal to 29. There's our exit on that. Okay. And I'm going to click on save. Let me just click on this. We're going to confirm and send. We're going to look at this and just review this here. Okay. Question in the chat. Is the $53, or in this case, it moved a little bit on us, $48, is it worth the risk? That's always the question. It doesn't matter whether we're talking about butterflies or any other type of trade. Is the probabilities worth the risk? Okay. When you're doing an option trade, doesn't matter the type of option trade, I want you to consider what's your max gain, what's your max loss, what's your probability. And closely tied to the probability of success is where's your break even or break even points, which is what we have there. If you know these three things, okay, when you're entering the trade, you're on a good position here in terms of the knowledge you need to make an informed decision on the trade. Doesn't mean the trade's going to work out necessarily, but that's kind of an important step there. Okay, so here's what I'm going to do. Now, I can do this. I can say, well, I want to do more than one contract because that's my risk on that. That's fair enough. You can always up the contracts here on this if you want. You can go down and click the wrong way on that. And let me just I clicked the wrong way again. There we go. Now here's a trade. I'm doing 2, 4, 2. That's the butterfly. And there we go. We're going to send that order. Put this in the butterfly. Oh, I don't have group set out right now, so I'm going to just send that, and we'll send that order, and we filled on that. So that's an example of kind of what I'd call just kind of a plain vanilla butterfly spread. Okay. So Myron said, where can you find the probability? Well, let's talk about it. We're going to get to that. I'll show that in the next example. I showed it briefly earlier, but I'll point it out a little more carefully this next time there. Okay. So let's go to charts. And I'm going to give you a different example here. I'm going to stick with this kind of volume profile. Here is Comcast. So Comcast, more or less kind of neutral. Remember, if we're really bullish, this probably isn't the trade. We may look at something like a long call or a long call vertical or something like that. Or if we're really bearish, the put variations of those. In this case, what I'm going to say is this. I'm going to say we're bullish a little bit here. So here's where my point of control is. Here's where most of the trading is. The trade has been more or less kind of going sideways-ish lately. We're above the 20-day, we're below the 50-day. Okay. So I'm going to take a little bit more of a bullish stand on this. Not a lot, up to maybe around the 34.5 level on this is going to be where I'm going to target that. And so we're going to do a similar thing, but then I'm going to skew this one and show you some differences on this one. So 34.5 is going to be about where we're going to do. I'm going to choose the same strike price for our last example. If we do a third example, which I think we'll have time for, I will change our I'll change our expiration, but I'm going to stick with this 21 days out because this is kind of here's what I'm saying. I'm saying for us to get here, we're not looking at a really long, it's not a big ask for it to go up less than $1. So it's not going to take a month to get there. So we probably don't need that much time on this trade. If I go to trade, I'm going to leave it on butterfly here, and we said 34.5. So I'm going to go to 34.5. In this case, I'm going to do calls because it's above the current stock price. Current stock price is at 33.8. Middle strike, 34.5 is a higher strike, so I'm going to click on my calls. I'm going to click on that ask price. That's just going to load that up. I'm going to right click on this. I'm going to analyze a trade. Now, and here's the trade. Let me go and set my slices on this to break even. For some reason, that is not doing that. Let me just throw another slice on there. Again, kind of a lower probability trade. So we can tweak this out if we want. But there's some other things we can do too. So when I'm talking about probabilities here, Myron, this is what I'm talking about. Here's your probabilities. To get the probabilities, you got to have the current date down here in the bottom right portion of the page. You got to have the expiration date plus 1 day. Okay, so the expiration is September 19th. We're going to make it September 20th right up here. And then you got to have your trade down here, and then you can set your slices, and you can look at the percentages there on that. So that's kind of tight there. So let's go out, and I'm going to widen this out a little bit, and we're going to see kind of a similar thing that we saw before when we widen the other one out. Do you see how that widened there? Our probabilities are getting better. Okay, when we do that, when we look at these probabilities now it's about 27%. Again, not very good probabilities. One thing you can do, though, is you can skew this. Look, when I say skew, what I mean is this. Right now, this is our center strike, 34.5. And this is $1 less, this is $1 more. If I want to skew this more bullish, here's what I'm going to do. I'm going to take this, hold on one sec, I'm going to take this, and I'm going to push this out a little bit more. Let's do that. Look what just happened when I just skewed that. Now let's look at our probabilities. Let me set my slices to break even. There is now only one break even, because if our stock goes up, it actually never gets to the losing point. Okay, Chris, great question. I'm going to address your question in one sec. Do you see, even if the stock goes up to $38, we're still a little bit, not much, above our break-even point. Okay, so in other words, our probabilities now have just shifted to make this a higher probability trade instead of a lower probability trade. But this is how you can tell your probabilities on the trade. This is how you can skew it. So if you want to find these and you want to go, hey, look at the, let's look at that chart. And we said, well, we're kind of bullish on this, but what if it keeps going up all the way? You know, there's kind of this is a pretty symmetrical, nice, volume profile, kind of almost like a standard distribution type graph. We're kind of towards the bottom of this. If this shifts up here, maybe it's going to keep going up a ways. I'd like it to be fine if the stock goes up in this range. And so there we go. By skewing your butterfly, you can shift your probabilities on that. You can also shift it from bullish to bearish, from neutral to bullish, or neutral to bearish, depending on what you do on that. Now, there's pros and cons of doing that, but there you go. By having this better over here, we're going to endure more of a loss if it goes against us for a while there. Okay, yeah, David's saying, looking at the probabilities, looks more like a normal distribution type thing There. So there we go. Now, Chris asked a question that's very pertinent to butterfly spreads. Chris said, so for butterflies, we may look for highly liquid stocks. For any option trades, we want highly liquid, okay? Butterflies or no butterflies. Then he said, with a falling ADX, what's ADX? ADX is a trend indicator, okay? It's a trend indicator. I'm not going to get into ADX right now, but just know you want a stock that's not strongly trending typically for butterflies. That's the typical approach to butterflies. And there you go. So yeah, falling ADX makes sense, okay? And a falling IV makes sense. Absolutely, Chris, you got it. Now, Tommy said the debit went up. Yes, the debit did go up. When I skewed it, the debit went up. How did I skew it? I changed the strike. I changed this strike. This strike was 33.5. Okay. I made it $2 wide on this side, $1 wide on that side. You can just click on it and change it right there. That's how I skewed it. But remember, there's no free lunches, folks. When I skewed it, there's a consequence. The initial cost goes up. The initial cost goes up, and therefore my max loss goes up as well. There's pros. I like that probability better. There's cons. I don't like the increasing the loss there on that too. But the thing with butterflies is they're pretty versatile. Do you see that? Can we do that to the bearish side of things? Yeah, we can. In fact, I'll show you here in just a minute. But let me just do this. Let's look at this trade and entering this trade. Remember, we're going to exit 4 to 10 days, about a week till expiration. We're going to look to get out of this trade. We can also put on exits here on this chart, and we could say, look, I'm happy to let this run on the high side. If this stock goes up here, like it's probably not going to, but if it did, we're not in a bad position on this trade, the way we skewed it. If the stock goes down, that's where we get in the bad position. But let's just say this, if the stock goes down here, maybe to 31, I want to get out of this guy because that is definitely not doing what I'm expecting it to do at that point. Okay. So let's do this. 31. So let me go to the trade. Let me skew this. We said, forgot what we did. We did 34.5, 35.5, 32.5. 34.5, 35.5, and 32.5. I think that's the trade we had right there. Okay. I can click on confirm and send, and I can look at my numbers here. Just you can read over those numbers. You can, to David's point, you can change the expirations. In this case, I'm going to go, my next example, I'm going to use a longer dated expiration on this, but you can play with the different expirations on that. Part of your choice in expirations is going to be how long you're trying to predict out in terms of the future on the stock. Okay. Now, I said I was going to put an exit, so I'm going to make this a first trigger sequential. I'm going to right click on this. I'm going to create an opposite order. I'm going to make this good till canceled. I'm going to make it a market order. And we said, I think we said 32. No, we said 31. We were going to get out at 31, I think. So I'm going to just get out at 31. Now, one thing I should point out, if the stock goes down to 31, that's not a great situation, but we're not going to be at max loss. We can even go halfway. Let me just be a little more precise on this. We don't need to be at even dollar marks. Yeah, I think down here, I think maybe 32 is the best. I think 32 may make more sense here to get out. If we go down to 32, what kind of loss are we looking at? Well, if it were to go down to 32 today, so I'm not going to take any time decay into account, our loss today would be about $47, about half the total max loss available on this trade. So not a good situation clearly, but it's also not taking the max loss. So let's put in that trade. I'm going to go, and we already changed this to good till canceled market. I'm going to click on my gear. We're going to get out at if CMCSA marks less than or equal to 32. That is our skewed butterfly right there. I'm going to confirm and send, and I'm going to send that order. And it hasn't filled yet, but we'll let that work on us. Let's give you one more example. Let's go out a little farther out in time here. Okay, a little further out in time. Here is Schlumberger. Here's one that I'm looking at, and I'm a little concerned. We have a channel on this. Okay, here's our channel. Here's our channel. My assumption, and you got to kind of go with this hypothesis. My hypothesis is this stock is going to slip back into this channel. Okay, it's going to stay there. But it's looking a little iffy right now, isn't it? The stock is right at the top of the channel, and it has a little bit of upward momentum right now, too. Some traders may just exclude that and say, I'm going to be bullish. My assumption is this, because the trading has been down here, we've been kind of in this channel. My assumption is this is going to break back down, but I don't know. Now, one advantage of doing it in this situation is you can have a quick exit. In other words, if this goes up much more, I think that it is we're going to know quickly that it's going against us if we break above. Because if we go up to, say, 38, we know we've broken out channel. And we're going to get out pretty quickly on that. So I'm going to exit if this guy goes to 38. But let's look at this. And I'm going to give this a little more time. My expectation is this isn't going to slip down to mid-channel necessarily in the next week or two. It may take a little bit. It may take a little bit more. Okay, so let me just get my pin is not working. 38. Okay. Where's mid-channel? Mid-channel is right kind of here. We'll go upper mid, about 35. But I really think it may go down further. So I want to give it more downside. I'm going to skew this to the downside. It may be ambitious to think the stocks can go all the way down here, but I'm going to pick an intermediate point where I think it's going to go down to around 35. But I want it to still be a good trade if it goes down here to 33 or something like that. So let's look at it. I'm going to go to trade. I'm going to go to butterfly. Let's go out a little longer. 21 days isn't very long on this. I'm going to go out 49 days. Remember I said 20 to 50 days. Let's go out. This is quite a bit longer here, okay? So, and then what we're going to do is we're going to do 35 was kind of our mid price. And stocks above that, so I'm going to do a put here. I'm going to click on the ask price of the put. We have a butterfly here. I'm going to right click, okay? And I'm going to analyze this trade, okay? Now, Raja says volume profile is showing 41 for the red line for Raja. Why would that volume profile show different for Raja than for me or for you? It should show the same if you're on a 6-month chart. I bet you, Raja, though, you're not on a 6-month chart. Because what this does is it takes into account all the trading on the time span that you're looking at. I'm only looking at a 6-month time span. If Schlumberger used to be trading up here more, then you're probably seeing it up there. That's why. Okay, let's go ahead. I wanted to skew this down. Well, remember, I want to skew this more bearish. If I want to skew this more bearish, how can I do so? You go to the high side and you change the strike price. I'm going to go to a 40 strike price. Now, look at this trade. Look at how it has changed now at this point. Well, hold on one second. Let me just double check. Let me unlock it. There we go. There we go. our stock right now is right here. Let me get rid of those marks here. Our stock is right here right now. Look at our profit loss graph. We'd like it ideally to go down to around the 35 range. If it goes down further and keeps going down, we're actually in pretty good shape. Okay, you can go down here, no risk. This is not a problem down here. Okay, it can keep on going down, right? Doesn't matter. But this is the ideal zone here. This is the ideal zone. The not so ideal zone is if it goes up. Okay, our break even is around 30, just a little bit below 38. But we said if the stock goes above 38, we're going to look to get out. Okay, so we're going to try to get out fairly. We have a quick trigger, so to speak, to get out on this, because we know if this thing just keeps going up, the whole channel hypothesis that I have that this is going to revert back into this channel is probably blown. So we're going to look to get out at that point. So let's go here. Let's see. I skewed this one. We made this a 40. And I'm going to right click on it. I'm going to create an opposite order. Hold on one sec. This was my original trade. Before you right click and create an opposite order, you got to change it and tell it there's more than one order in here. I just had a single order in there. So let me click on first trigger sequential. Now when I create an opposite order, okay, I'm going to go there. And so here's what we got. This is our trade. So this our hypothesis here, Sean, is we're going to drop back down into this volume profile channel, which we could also just draw support and resistance lines here and get the same thing essentially. If it breaks out, we're going to exit about here. If it goes down, great. That's what we want. Okay. Do you see this? Do you see how butterfly spreads are very customizable? Do you see the variety that you can do with these butterfly spreads when you do these trades? I'm going to make this good till canceled. I'm going to make it a market order. And we said we're going to get out if this goes above 38. Symbol, mark, greater than or equal to 38. We're also going to get out. We're not going to hold this to expiration. We're also going to get out if we get to about a week till expiration. We'll look to exit that trade. That's the trade right now. Okay. So let's take a look here. That's mid price. Let me just go up because I want to get that filled. We'll confirm and send, and we're going to send that order. Okay. Let's kind of summarize what we did here. And I appreciate Scott helping me out in the chat here on this. And I appreciate you and your questions here on these. There's the plain butterfly spreads, which are more neutral-ish type strategies. Typically lower probability trades, but high reward if you kind of hit the mark. Okay. Whereas something like an iron condor, we can make that a higher probability trade, but typically a lower reward trade. But the beauty of these butterflies is we can adjust them. There's variety, just like butterflies out in the real world. We can make them a little bit more bullish. We can make them a little bit more bearish, partially by choosing just the initial center strike, but also by skewing it, by giving a wider difference between the center strike and one of the sides. If you want to make it more bearish, give you a wider gap between the high side and the center strike. If you want to make it more bullish, give it a wider gap in your strikes between the center strike and the low strike there. Okay, so there you go. Everybody, that's butterfly spreads today. Thank you for joining me. Coming up next, we got market movers. What a great way to finish off your week. Make sure you subscribe to the Trader Talks channel, by the way. It's how you're not going to miss this information. So you just on YouTube, if you haven't subscribed already, look in the bottom right portion of that window to subscribe. You should be able to subscribe. If you've already subscribed, don't click on it again because you may unsubscribe there, but makes it easy for you. Thanks for joining me, everybody. Have a great day, and we'll see you all same time next week. Bye-bye, everybody.